Buying an apartment building is a huge leap for any investor. But the problem is many investors rush in and skip some of the fundamentals. Now, when you skip the fundamentals, your risks are massive. The more units you buy, the more risks there are. At Faris Capital Partners, we have over 500 units, and we've learned what the 5 key must-haves are, and we're going to be going over that today and save you a lot of heartache moving forward. If you are thinking about investing into real estate and you can't find any good deals out there, go to fulloutinvesting.com and you'll see our full out investing process. And we also have a sample deal on there as well. So you'll get a good understanding of how we structure our deals. And you can book a one-on-one call with John and myself to find out if this is going to be the right fit for you. So that's fulloutinvesting.com. John, it's great to be here with you.
Great to be here, Mark. You know, one of our core values is to make wise choices. And one of the ways we do that is through wise counsel, right? So, you know, prior to starting Faris Capital Partners, you know, you raised some capital on a couple of deals, just learning the business. But, you know, between the both of us, we probably read just about any book you can ever read on this stuff. And we have great, you know, consultants that we work with, folks that have been in this business for 10 plus years, that have walked the walk and performed. And so, you know, thankfully we had someone who, you know, or really say a lot of people that were helping us avoid these common mistakes. And I think the team is obviously a big component of that as well. Folks like Georgia Patrone, our asset manager with over 20 plus years experience, and Joe on the acquisition side. I can keep going, Madison, CPA. So we built this really incredible team. So we've been able to avoid a lot of these traps. So for a new investor, or maybe an investor who's, you know, kind of dabbled in single family and thinking about getting into multifamily, you really want to pay close attention here so you don't make any of these mistakes.
Mm-hmm. Yeah, and to set the stage, when you're going in and buying an apartment, it's really important to not just look at it as a building. Look at it as a business acquisition. That's why if you have a business background, you actually have a competitive advantage when you're going in and buying these buildings, because, you know, if you operate it like a business, you're going to do a lot better. You have income coming in, you have expenses going out. So you have net operating income in a apartment, you have EBITDA over in a business. And so if you look at it that way, that I'm just going to set the stage here of like the must-haves. If you have a vision, or we'll say insight, when you're looking at the building, think of it as a business. And if you do that, you're going to be able to look at it very differently. And your background that you have in business will actually help you in a big way at being more successful in apartment investing overall. So I'm just going to set the stage with that before we get in. That's kind of like a bonus one. That's a mindset thing.
That's right. Yeah, it is. It's exactly the way to think about it. I mean, these are absolutely nothing more than a business. And our goal is to go and improve the operations, drive additional income, and reduce expenses. So it's no different than a private equity firm acquiring a business, you know, that's maybe makes a widget, right? Our business just happens to have rental properties available for potential residents. So that mindset is critical. And going into this kind of investing with that mindset will just in and of itself give you that edge. So no doubt about it, right? Yeah. So one of the first ones, Mark, you know, and I know we spent a lot of time on this, is identifying the right property management. At the end of the day, like, these investments really start prior to closing, because, you know, we have to not only build a great business plan, but we have to execute starting on day one. So, you know, when you find the right property management team, for example, they're a part of your due diligence process. So they're working alongside us at Faris Capital Partners as we do a full lease audit. We do 100% unit walk, where we literally step foot in every single unit in a building we're considering buying. And then, of course, we're doing all the, you know, property condition assessments, environmental assessments, all those other things. But having the right property manager in that due diligence process in and of itself gives you an edge, because, you know, they have that sub-market knowledge, and that's a critical factor here. You know, just choosing a property manager that does business in Texas and then saying, hey, great, we want you to manage this asset in Charleston. Could they do it? Maybe. But wouldn't it be better to have somebody who knows that market backwards and forwards and just can help you make a really great decision? So they're helping us now. I say with rent comps, one thing we do is we pull our own rent comps, and then we ask them to pull their rent comps, and then we do a comparison. So we don't share our information with them. We want to see what they come up with first. But they're alongside us throughout that whole process, such that when we close, on day one, we're in full operation mode. We're like execution. Our renovations are starting. Tenants have been informed about the new ownership, and we're adding value. So having the right team that can move at your speed is really critical here. And not all property managers are created equal. So it's definitely one where you're going to want to go out and see every property manager in the market that your building is in, and interview every single one, and do a lot of due diligence before making that decision.
Yeah, that's a big one, because if you get that wrong, doing it during the whole period of the asset, especially when you're getting into the larger unit counts, is not fun. It's not fun. And so doing your due diligence ahead of time, and that's where, part of the benefits with us, John, is that we've gone through, we've vetted, and we have other assets that we're working with. And so our property management company knows, like, we're pretty, we'll say, I wouldn't say high maintenance. We have high standards, high standards. So we expect a lot for us, and we're very hands-on on our assets. But there's no surprises with our property management company. Even when we go into a new city, it's like they understand our standards. And most of the property managers that are out there, a lot of them, especially in the larger unit count, they are multi-state. So it's not just, you're in that one market. Some of the smaller companies are. But by getting the right property manager, it will just say it's worth its weight in gold moving forward to be able to move quick, especially when you wrap up a deal. You need a property manager from the get-go of, like you had said, John, doing the initial walk tour and make sure that they're comfortable with the rents that we're about to charge.
That's right. So this property manager should have a lot of experience in the unit count size that you're acquiring. So, for example, there's some great firms out there that do single family rentals, right? That's what they focus on. So hiring them to do a 100-unit apartment building would not be the right decision. But also, even further into that, do they have experience with value add, which is what we do? So construction management is a component there. Now, we have our own construction manager in-house, but if you don't, having that done by, often the property manager is helping to quarterback and navigate all those unit renovations and all the CapEx, the work that you're doing, that renovation plan. So a lot of thoughtful questions need to be asked, and a lot of references need to be checked. And thankfully we have access to CoStar, which is basically a listing service for commercial real estate, and so we can actually search through the properties that they manage and verify this information independently. So it's beyond just having a 1-hour Zoom meeting and saying, "Oh, you guys are great," right? You got to really go deep in their experience, their due diligence, and show us the wins, because ultimately they are a key component here to the success of the deal. And maybe you go and you start doing some research, and they manage a lot of this stuff, but the exits aren't super strong. Maybe they have negative reviews online at some of the assets they're managing. And at the end of the day, we could have the best, beautifulest, most awesome property, but if the property management team is treating people poorly, they're going to get bad reviews, right? So looking for reviews. So it's a very in-depth process. It's not a quick decision. You might get a great referral, but don't take that referral at its word, right? Go out and interview many. In fact, something we think is just a best practice with all of our vendors, but on an annual basis, like going back out into the marketplace and seeing what else is out there. We don't like making unnecessary change, but at the same time, we have high expectations, as you said, right? So we want to make sure that we have the best that we're working with across all that we do.
For sure. So trust a property manager that knows the market really well. That's the first one. The second is a fully built out CapEx or capital expenditure budget or renovation budget, said in more simpler terms, with a contingency. So you have a buffer in there that is a just in case. And so this is a big one going in, and this is where I see a lot of operators get it wrong. They go in and they go like, it's just a ballpark, and they kind of wing the budget rather than dialing it in and getting it tight. And so, especially when you're starting to get into older vintage, you're getting into the 70s vintage builds where you can start getting into plumbing, you can start getting into, aluminum wiring, you're starting to get into more of the structural issues of properties. That's where your budget can go out the window. And that's one of the reasons why we like the newer assets. And if we are going to go after something later than 1980, and we got to really do our due diligence to make sure we dial it in. And so by getting into more, we'll say superficial, we'll say cosmetic renovations, it allows us to get very tight because we know what a renovated unit is when it comes to kitchens, bathrooms, flooring, paint, You have hardware and light fixtures, for example. That's all very straightforward. We know those costs because it's rinse and repeat because we're doing hundreds of units. But when you start to get into the bigger lifts, make sure your budget becomes even more and more and more. And it's a massive way to be able to go underwater. And especially if you're buying a vacant property and you're going in and you have a renovation budget, the contingency that you need, I mean, we have 10% contingency on top of what we believe it's going to be. And we've been thankful that, we haven't actually gone into and exceeded that anywhere close to that because we've been on budget with our renos. But when you start getting into vacant properties where there's no income coming in and you get your budget wrong, that's where you can get into a lot of trouble by not getting it right. So going in and having a trusted general contractor going in with you that has proven themselves to you to make sure that they're going to stay on costs is worth its weight in gold to be able to ensure that you're going to get a consistent, solid, and we'll say consistent result in regards to the returns that you're going after because you could get a real win on one deal, but the next deal you can lose your money as well if you don't get it right. And the CapEx budget is one of the biggest ways that operators lose when it comes down to getting high returns.
Yeah, and you sort of touched on this, but ensuring that your budget is approved by your property manager as well as the construction manager or general contractor you're working with, right? So part of our process, since we have an in-house construction manager, is he's on the initial property tour with us. So, we look for all that stuff too. But, a lot of times we're thinking about the business plan. We're thinking about how can we improve this amenity? And he's the one opening up all the closet doors and inspecting all the HVAC systems, and going, geez, these things are on their last legs here. So we're going to have to go back. So prior to touring, we create a business plan and we start developing a budget based on what we think will need to happen. But then once you tour, you might find some new information and it could be good. Maybe you realize, oh gosh, they actually have more new appliances, more stainless steel appliances, for example. We had that recently where we weren't really sure, the broker wasn't really sure, but then you start getting in there and so you're like, okay, we can reduce some spend here, but then you find something else and you're like, oh, the wells, the irrigation system's not working. We need to repair that, right? So
perfect example is a couple of weeks ago in Atlanta. So we were looking at that deal.
Yeah.
We're like, we're going to go after this asset. And we toured, we brought our GC there and we started walking. And so, I went for a walk with the GC and we started looking at the retaining walls. And, it was interesting because the retaining walls, there were all the wood beams. But what was interesting, there was a lot of places where there was overgrown like ivy that was all covered in green. And we stuck our finger through the green and Tom, his finger went in and it kept going.
Yeah,
I was like, hey, look at, I was like, and we saw there was about 800 feet of 6-foot retaining wall that was all rotten.
Yeah.
And so we did the numbers and this was going to be hundreds of thousands of dollars of repair that if we didn't do that tour and we didn't look close, that would have been an adverse effect on the overall returns. And so we've said, you know what, listen, we got to factor that in. And all of a sudden the returns change and it didn't make sense. So you have something like that comes up. It's so easy to miss. I mean, that was all covered. And the broker is like, oh, there's just this one wall over here. And, maybe they didn't do that full tour like we did. But that's where if you get that one thing wrong, that can be, even the asset in Charleston, the one deal that we did there, John, we took it over from the operator and they had another asset where I think it was their plumbing, right? That it was like $1 million fix. Can you share that example? I think that's really important.
So what we actually heard is, so this operator went out of business over this, or sort of liquidated all their assets to get themselves out of this jam. But basically they bought a 70s asset, which, once again, if we were going to buy anything in the 70s, it would, we already have a very extensive due diligence. So let's just say it would be through the roof. And so building materials pre-1980s were not as heavily regulated. And so there was a lot of problematic, like class action lawsuit style stuff going on. So all that to say, they closed on this deal, and within 3 months of ownership, the plumbing system completely failed and required a complete and total replacement to the tune of $2.2 million. And from what I understand, a lot of their investors were investing in all of their deals. So in an effort to make up and not cause any further harm, they liquidated all of their assets. And it was actually kind of sad. From what I understand, the two operator partners, by the time the whole thing ended, hated each other's guts and weren't even communicating anymore. And so just not being as diligent with that inspection process. And so look, I mean, we closed on a deal recently that was built in like 2008. We still had all the plumbing lines cameraed, right? Because you just can't take it for granted. Yeah, it's new and it's relatively new and it's in good condition. Nobody's reporting any issues, but why not spend a few bucks and have a plumber come out there and camera the lines just to be sure? And so, that was a miss on their part, but it was the end of their business effectively. In fact, I was talking to a broker today, and I'm not going to name the name, but that is kind of legendary in that market because, a lot of the deals that traded in Charleston last year were a direct result of the fire sale that occurred. And thankfully we picked up a couple of deals from it. But the guy was using that as an example of deals that you're not really going to ever see again, because they were really screamers. I mean, shoot, I think we calculated about a 27%, if I'm not mistaken, reduction to peak of value on that deal. And it was largely driven by, I hate it, but their pain, and their mistakes. So,
they're beautiful assets too.
And it wasn't our deals that this happened to be very clear, but it was just one of those things we were able to benefit from it. But yeah, man, I mean, all it takes is one mistake like that to really ruin the returns on a deal. So just having a fully built, renovation plan, baking in a contingency, and not trying to save a dollar during your inspection. Right? Don't step over dollars to pick up dimes here. Spend the money, ensure you're buying the right deal, because as a company, we would rather burn a few $1,000s in due diligence costs and not buy the deal than find out after we close we got a $1.2 million mistake on our hands.
Yeah, the saying is so true here: an ounce of prevention is worth more than a pound of cure.
Yeah, that's right.
And it's all like fine and dandy until you get behind the 8 ball, and then it's like, oh my goodness. So I'd rather not go into a deal and that was exactly what happened with those retaining walls. It was like, you know what, we could factor that in and it'd be a little bit tight, let's go ahead with it. It was like, I don't want that headache, I don't want that, that maybe. And so for us, it's like, we'll wait for another deal. Yeah. And although, John, that's one of the challenges is like, we got to go. So that last deal that we were going after, the seller ended up at the last minute deciding to pull it and not actually sell it, which that's part of the business as well. But that took us 300 deals to find that one when we were in best and final. And that's how rare these deals are. And the thing is with us is that if we get into a deal, it's like that could be a 5-year timeline, a 5-year commitment to that property. So that's one of our 10 things that we want, as you know, John, is like, it's a property that we can be proud of. We don't want to sell it in 5 years and be like, that property was like a nightmare. That, we don't need that in our lives, John, and our investors don't need all the drama in their lives when it comes to the deals as well.
Yeah. No, 100%. It's, it's not easy, but it should be enjoyable, is how I kind of think about it, right? Like you should have fun with this because, we're improving residents' life. We're improving a building. It's really fun to watch that process take place. I love nothing more than visiting halfway through the 28-day transformation and then like at the end of it and seeing that progress occur. And our residents, right, see how happy they are, right? The deal we just closed in January, adding those new fences, given that private backyard, some of the reviews we've already received from that are huge. So, once again, it's not easy, but it shouldn't be, a pain, right? It should be kind of enjoyable. So I think the third one really to think about is ensuring that you have a clear debt strategy, and that you have actual conversations with lenders, and you have soft reservations for your capital needs. Now, what we find, Mark, is most of our investors want to actually see and feel and not necessarily touch. They're not always traveling down to see it literally, but they want to actually investigate the actual deal before they commit. But we're talking to investors that, that were either currently invested with us or interested, and we're getting a commitment that, yes, if I like the deal, I'd be in. So we're not just like getting the deal under contract and then going, oh, let's go figure out where our money's coming from, right? And then on the debt side, Fannie Mae and Freddie Mac, they're government-sponsored entities that do a lot of lending in the multifamily space. They have very clear published guidelines. You can kind of quickly and easily see, should I qualify? But what's also happens if you're new to them, you actually have to have like a key principal sponsor, somebody who's done business in the past. So if you just go in and put a deal under contract and then start that process, you may find out you don't qualify, and now you've lost earnest money or you've lost your reputation with that broker. So ensuring that's fully baked out, you've had conversations, you've had an initial underwriting completed, so the lender's coming back saying you should have no problems here getting approved, and then you submit that offer. So it should go without saying, but you'd be surprised. In fact, a lot of the brokers we talk to, depending on the market, about 75% of the contracts that they, deals they put under contract, I should say, fell out due to either A, inability to get financing, or B, inability to raise the capital necessary. And, I think about Warren Buffett, right? He sends a letter out to every CEO that works for him or that he's, invested in. And it basically states that, you can experiment, you can make some bad decisions when it comes to maybe income into the business. If we lose a little money one year and, it was a good plan, but maybe it just didn't work out, I can live with that. But I can't live with is any damage to our reputation. And, this letter was last year, whatever. He's like, look, it took 37 years to build this reputation. It takes 37 minutes to destroy it. And with brokers, right, all it takes is one sideways deal for them to kind of put you on the list, so to speak, where they're like, just don't want to do business with that group because I spent 5 months chasing them around and the deal didn't close because of something they failed to prepare for. You will never get another opportunity from that broker again. And anytime you submit an offer, they're going to tell the owner, I'd be cautious. These guys don't close. So we know when we put something under contract, we have to close, right? And I think you said it one time, like, John, the way I look at it is we'll die if we don't get this closed. So you have to have that mentality. Like, we are putting this under contract and we are closing come hell or high water. And so that's how you think about it. So having that strategy fully in place, and, you have to have, because here's the thing, Mark, right? There's debt service. There's all these things you have to think about, right? And so looking at even like your yield maintenance, which is really, to say it another way, your prepayment penalty. Maybe you take down some financing, but you didn't underwrite that into your deal. And then you go to exit and realize you have a 1% prepayment penalty, right? So it's not just getting approved, it's underwriting the whole thing into the deal, right? So it's not easy. It takes a lot of work.
Yeah. And that was a big part of, we're going to be talking about that as our losses, about the team as well, and making sure that you have people that have been, many, many decades of time to be able to catch all those. Because a lot of times it comes down to experience. But I'm going to save that. And before I get into that last must have, the next one is your business plan, a clear written business plan. So your business plan is basically, how are you going to execute to be able to drive value? How are you going to add value to these assets? So one of the things that we like about what we're buying, we like buying B-class assets that has a case for us to go in and add value. They're already cash flowing, these assets that we're buying, so it's already making money. We could do nothing and it would still be an okay return, but okay is not good enough for us. We want an outstanding return. So what is the business plan that we can go in and actually 1 + 1 = 2. So if we go in, we know that we're going to say renovate the kitchens. We know we can get a $150 rent bump per month. And if we do that, say if we do $100 rent bump for 100 units, that's $10,000 a month. That's $120,000 a year in increased net operating income. Based on a 5 cap, we are raising the value of the building by $2.4 million. And so we can actually write that out, and then we can budget that and then when we're going to execute on that as well. And so that needs to be drafted, written up, and clear before you close on the asset. Actually, when you go to your investors, that's something that your investors want to see. So we spend all this time up front building it all out. And then when we present it to our investors, there's a clear business plan, a clear path to be able to get the returns that we're projecting. And that business plan is something that you don't want to skip. It's incredibly important to be able to write down. Just like if you start a business, you should have a very simple, at least a 1-page business plan. This is how we're going to make money. This is what we're going to offer. And there's no difference when it comes to buying your large multifamily deals.
That's right. And, to add to that, just make sure you're being conservative with your rent growth and expense assumptions. Make sure you're studying the comparative sales in the area, the comp rents in the area. And the bottom line, Mark, is that Fannie and Freddie and even the private lenders that play in multifamily, they're scrutinizing the business plan as well, right? Because ultimately the asset itself is the collateral for the loan. So if they think you have a kind of a goofy or not a well thought out business plan, they're just not going to approve you for the loan, because ultimately they need to know if something were to go wrong and we have to take this building back, that they didn't go in and paint the building pink and put in a bunch of amenities that nobody wants and made the deal potentially less valuable. So for so many reasons it's important. And the way I think about it is every team member at Faris Capital Partners needs to be able to clearly articulate that business plan in a few sentences. This is what we're going to do. And when you have that, you've got a good plan in place.
Yeah, right on. Last but not least, John, this is what I think is the most important one to make sure you get right. Even if you are an individual investor and you're buying a building, you still need your power team. So making sure that you have your team ready to go. And if you are going to do everything on your own, be ready, because there's a lot coming, especially when you start getting into the larger unit counts. Like for me, John, prior to getting into the business a few years ago, the multifamily larger syndication, buying the 100-unit deals, I'd buy the single family deals. I'd do it kind of all on my own. I'd buy the 6 and 10 and 14-unit deals, and I'd hire a property manager, and I would do it kind of on my own. And that was somewhat manageable, although looking back on it, there were a number of things I didn't do now that we're diving in. But having your team ready to go when it's actually as when you're looking for the deal, because they'll help you. It's like, when's the right time to build your team? It's like now. It's like before you find the deal. So because they'll tell you in 3 seconds flat if you get the right team. That's not as good of a deal as what you think, and here's why. It's like, oh, thank you. You saved me a lot of heartache on that.
That's right, man. Yeah. So, for us, that team, the experienced asset manager, as I mentioned before, we have our own in-house construction manager. We touched on the property management team, but you also need a strong legal and accounting team. We raise our capital, in-house. In other words, we're not going out to brokers or broker dealers, but, a firm capital raising plan and support. And, it goes back to, once you have that team, making sure you have strong meeting rhythms. So for us, that's the daily huddle, the level 10 meeting, asset management meeting, deal review meeting. So we have a very structured, predictable schedule where the team knows they have to get together and they're going to be held accountable, not only to, their own personal, kind of contributions to the business, but, the properties, right, themselves. So, we're meeting regularly. So Madison, George, and I, we meet regularly to review the property level financials. Collectively as a group, we come together to look at the value created. So it is not just a, set it and forget it plan. It is a highly engaged process. So yeah, going in alone, Mark, on a 100-unit deal, that would be,
I mean,
good luck to you.
Like you're about to start like a race car, and you're bringing a little tiny, we'll say a tricycle to the NASCAR race, right? You go, okay, let's line them up, let's go, and you got all these. You got all the NASCARs lapping you when you're trying to do it. Now, maybe it's not that big, but I mean, the reality is the moving parts that we have with this deal, because with these deals is things are moving fast and things are moving in unison as well. So the reality is taking one down on your own. Even if you had two people doing it, it would be a lot. You really need to be highly organized, and like that's your full-time thing, because if you don't close on the deal, like you'd said, John, like don't expect another one of these to get presented or awarded to you, because you got one shot. If you don't get it right on every deal, it's like no matter what you did, it's like that reputation could change. The Warren Buffett quote you gave earlier was really good.
Yeah, that's right.
So to recap here, guys, you want to make sure your property manager, get that wrapped up. You want to make sure your renovation plan is tight. Your capital and your debt is lined up as well. And your business plan, and last but not least, your team. Make sure that you get your team down, because by doing it, it makes everything smoother, faster, and it gives you less probabilities of running into something or missing something that you would overlook if you're doing everything on your own. Preparation wins deals and protects returns every single time. Now, if you are interested in investing in real estate and you can't find any good deals out there, go to fulloutinvesting.com and you'll see our 10-step full out investing process, and you'll see a sample deal as well. You can book a call with John and myself to learn more, to see if this would be the right fit. And thanks for listening, guys. If you enjoyed the show, please subscribe and share with other high net worth investors that you think will benefit from it. We love and believe in you guys. Keep dreaming and investing big.